There's only one thing that this market cares about right now, and it's clearly the Q1 2024 rate cut. Now, Jay, that's Owl of course, can play Mr. Tough Guy all he wants like what he did on Friday, but the market just disagrees about higher for longer, big time. So let's walk through what exactly that means and how we can build a game plan for the coming week's worth of trade. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 5 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY monthly time frame, now that the November bar has closed out, what do we see here from a candle structure and location point of view? Certainly a solid green-bodied bar closing near the highs of the very expansive monthly range. No wicks to really look into. I would say buyers are clearly in control here. If we think about location on the bar-to-bar count, certainly a higher low as well as a substantial higher high. Buyers go 2 for 2 on the monthly count structure and location. And all of this really revolves around the monthly higher low thesis, right? If we do something like this, as we know, the monthly inverted head and shoulders got a breakout here to change the monthly trend, and the retest for a higher low on the neckline would confirm the new monthly uptrend, right? We have lows, higher lows now found after going highs, breaking to higher highs, and from a trend count perspective, we're just sitting right back at the equal highs. So we really have 2 outcomes here. We could look for trend continuation over the top of what's now becoming a cup and handle like this for a monthly breakout. All-time high would certainly become a target. Or the contrary is that we get some sort of pullback in the month of December and we could look for another monthly higher low. That's certainly valid in terms of keeping the monthly uptrend alive, considering that we're coming from a higher low and we've already produced an equal high. So continuation or another higher low pullback here on the monthly time frame chart. Everything about this is really looking and feeling more bullish than bearish. And if that's not enough for you, I mean, just understand that we're well above an upward sloping 50-month moving average. And you can take it one step further. All of this, even what seemingly was an atrocity of 2022 happened over the 38.2, just barely dipped a toe underneath. So in the grand scheme of things, coming in from the sickness low to the all-time high, this has been a mild bullish, pullback over the 38.2. Like, there's really not much to say in terms of bears being in control when you're on a higher time frame chart like the monthly. And once again, if this truly is a cup and handle, and if we're going to get a breakout over the equal high of this handle, I mean, all-time high is a target, but the measured move is from the top of the cup to the bottom of the cup. You're talking about blue sky territories there. So everything here on the monthly time frame does again appear more bullish than bearish. Large bullish engulfing bar taking back 1, 2, 3, not days, not weeks, months worth of bearish price action all over the span of roughly 30 days. So a very bullish month of November. Let's move on down to a weekly time frame chart, get a little bit more granular here and talk about what we have on tap for the coming week's worth of trade from this point of view. So structure and location, just like we always do now on the weekly time frame chart. Certainly a solid green bodied bar, very minimal lower wick. If anything, it would just suggest that the buyers stepped up off of the lows and they were in fact able to close near the highs of the weekly range. Buyers in control from a structural point of view. Location, bar to bar count, higher low, as well as a higher high closing outside of the previous weekly bar. So 2 for 2 on the weekly count as well. Higher time frames have to go to the buyers at this point in time. As we know, it's typically elevator down, stair steps up. It's been exactly the opposite, where we got sort of this stair stepping action to the downside, and it's been nothing but an elevator in the upward direction. Now, is it possible that the weekly chart could pull back after finally accomplishing the equal high to the summertime rally? It's possible, but once again, nothing about this weekly bar structure would suggest that buyers are stepping up at that equal high level. If we scrunch this chart out, we know that the next major overhead target before the all-time high on the weekly is really here, this prior shelf of resistance at 470, and it also offered a little bit of a rejection in the upper wick of the green inverted hammer from back here. But let's just say that the market is tired. We've been up now, 1, 2, 3, 4, 5 weeks in a row, no pullbacks on the daily time frame chart either. If we do get a pullback off of the equal high here, what are we looking for as possible areas of support? It's really the same 2 that we talked about last week, with the addition of another new weekly level. And you're going to really pay attention to 451, and we'll see that on the daily as a little bit of a range over here. But if the weekly chart produces consolidation up here, you might be like, Matt, that's not even a pullback, that's just consolidation. I'd sort of agree with you, but noting that there was, again, No hesitation on the retest here. No hesitation on the retest here. No indications of a pullback coming around the corner. If we just consolidate sideways through time like the daily chart has been doing, if we can hold that over 451 on the weekly chart, very, very bullish look here on your SPY weekly. As we know, underneath that, you technically have the CPI gap close, which is here at 441, also very close to the bottom of the double inside bar range. And then the next and really line in the sand from a weekly higher low perspective is the retest of the neckline, which kicked off the weekly double top. There's your downtrend on the lower high retest underneath. If we were to pull back to that, that's again a must hold level at this point in time for your weekly chart. And we know that there's lots of confluence at both of these levels. If we bring out the weekly anchored view apps, you're getting confluence with all three from the October low, summer high, AI mania breakout. All of that is sitting right here virtually at 437. Remember that the pullback level, that structurally relevant level from the neckline and then lower high retest, 437.35 is the pinpoint level, right? So big confluence there on the weekly. If we come in with our Fibonacci's from the low of the October move to the most recent high, your 38.2 is sitting at 440.15, about $1 shy of the CPI gap fill reversal, which would be at 441. And let's also bring out our volume profile just to bring it full circle. What do we see from this point of view? Obviously, we've broken out over the point of control. We're over the high volume node. So a couple of things, like this is really where the shelf starts. That's almost confluence with 451, right? If that's kind of where the shelf starts. Above this, we really have a low volume void, and maybe there's a little bit of an argument to be made for a high volume node at 470. Any deeper pullbacks, you're just talking about confluence once again. I mean, your point of control is at 443.41, CPI gap fill reversal. A couple points underneath that, you're still in the high volume node, right? You haven't fallen out of it yet. You have the 437.35. So there are a lot of reference points underneath us. Once more, just to sum it up on the weekly, on the monthly, buyers totally in control. There's nothing suggesting that a pullback is imminent, but if one does decide to unfold, we are well prepared with well-documented levels. On the daily time frame chart, let's begin by evaluating the expected move for the week. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is 464.90, implying some sort of higher high. That, of course, is bullish. If we're contained by the lower bound, the number is 453.25, basically on par with the consolidation lows. I would call it an equal low, still kind of neutral or even with a bullish edge, considering that we're in an overall daily uptrend. I mean, it's very hard to argue that we don't have lows, certainly higher lows. After pulling back, we actually did flip into an hourly downtrend here, especially with the breakdown on the Thursday morning session. But regardless, we've broken to a higher high. So the trend is up at this point in time. What the buyers would really prefer to see is that any daily pullback holds a higher low over 456.30. That would be the ideal rainbows and butterflies pullback for the buyers to continue this trend in the upward direction. If that's the case, an equal high breakout over 459, then targets 461.75. Upper edge of the expected move is a loose target, but beyond that, it's really not much. Remember that the VIX was well elevated when the breakdown was taking place, so these ranges seem really expansive, but they were normal back when the top was put in early 2022, right? So 471 would be your next overhead target, and we also understand that from the weekly chart as well. So those are your upside targets if we get trend continuation. Now let's think about what's going on here, because Wednesday is technically an hourly downtrend. And this, of course, as we pointed out, is a breakdown to a lower low on the Thursday session. Now, buyers clearly respond with a close on Thursday near the highs of this as an overall balance range. And this higher high closing over Wednesday's high actually validates a breakout of this balance range, and we could technically look for day two continuation. So don't be surprised if the market tries to make a move in the upward direction to play off of the momentum from Friday. The only hesitation I have with something like that is understanding that when a balance range breaks, we typically look for a doubling of the range, and obviously we've hit that target at 459. So that's my only hesitation there. If we're going to flip into a daily downtrend, a couple things need to take place. The first and foremost thing needs to be a lower low underneath the last higher low. And once again, because we did find an hourly downtrend, this is your last daily higher low, 453.90. If we can break that, that's a good first step. You have a lower low. Ideally, after that, any lower high is produced underneath, or underneath here, the top of the balance range at 456.30. Let's go ahead and throw on our anchored view apps. I just want to show you this, that again, there's no reason to be overly aggressive bearish. There's no indication that there is an imminent downtrend brewing, but from the CPI gap up, if you anchor a VWAP to that, it's right at the lows of the balance range. I just want to reinforce the idea that you should start to think about at least a daily downtrend if we were to break that level. Notice that I'm putting a lot of emphasis on the if there. It seems as though everybody just looks at the thumbnail. They're like, oh, he's got to be bearish. No. We use an if-then approach to the market. The weekly analysis is bullish. The monthly analysis is bullish. The daily chart here is bullish. If we break the lows, we will change our tone, IWCMT, right, underneath 453.90. So watching that like a hawk if there is a trend reversal. Hopefully, I've been very clear about that. Now, let's move along to the hourly time frame chart and see what we can learn about the granular aspect of the price action over here. So it really all begins with Thursday's end-of-day ramp in the upward direction. Why is this so critical? Because it's a failure of the hourly downtrend over here, right? Technically, we have highs, lower highs back within the range. Remember that these are the excess highs from Wednesday of the Thanksgiving week. So lower high there was a bit of a nail in the coffin. We broke to a lower low into the end of day. Thursday opens inside of the range and we break from the balance range. I mean, look at the hourly inverted hammer, right? So we were trying to get price acceptance underneath that 453.90. That end of day ramp kind of puts a nail in the coffin for the sellers. It just does not take place. So from there, let's look at Friday's open. Where's Friday's open? Of course, it's this inverted hammer, but notice that there is no price acceptance underneath the Thursday open. So what does that mean? Anybody who was short on the Thursday session is underwater as of the open from Friday's session. And of course, we know that the PMIs came out. The market's like, whoa, we got to cut rates aggressively, and we're off to the races. You can give your little Powell injection, whatever you want to say. That's ultimately what's happened here. You had a failure from the buyers at the highs, which in turn is a gift to the sellers. Then you had the sellers fail that gift, which then in turn gives the gift back to the buyers, and the buyers finally made something happen in the upward direction. And should we be all that surprised? Not really. When the weekly trend is up with lots of momentum, the daily trend is up with lots of momentum. So very, very clear, buyers are in control. What does this mean ultimately for, the upcoming week's worth of trade? Well, breaking to this higher high, as we pointed out, is bullish. So anything goes for a higher low over the top of the balance range. Pullbacks that would seemingly appear to be deep could still be valid over 456.30. That's also a daily higher low as well, right? From there, it's continuation up and over 459, and the same thing holds true at the highs, right? If this is bull flag consolidation, a break retest higher low on something like a 15-minute chart, which in turn kicks off or continues the hourly uptrend, also bullish, start looking for your upper targets as we've described. Where do the bears really start to see something happen? Well, as we talked about, first and foremost, you need a failure back into range, because on any subsequent tests of 456.30, it should be thought of as a bullish retest, right? You really want to be looking for hourly double bottom here. You want to be looking for hourly inverted head and shoulders if the daily trend is going to remain in the upward direction. So that's what the buyers want to see. The bears want to see a failure of that, right? They want to see a move into this range with a lower high and then your daily breakdown to violate the lower low underneath 453.90. Another situation I could imagine is, okay, let's look for this. Then we get here, if this turns into a double top, again, it all hinges upon, use that if-then statement, a breakdown back into this range. This would just be equal highs. It would not be a higher high, and thus we wouldn't really be looking for a higher low, right? The trend is able to change after an equal high. So then through the lows, you kick off your daily downtrend, right? So 453.90 is still that all-important level. Let's quickly throw on the anchored VWAPs from an intraday perspective, just so we can see these, if there's any confluence here. And the answer is yes, right? So for the most part, as we talked about on the daily, there's your CPI gap up, slowly providing confluence with the lows of the daily balance range that we care about. So if you're only going to have one number to try to pull off a bearish trade this week, you have to be underneath 453.90. Right? Anything beyond that, maybe there's a double top up here and you can break that neckline. That's a possibility, but we don't have that in the cards yet, right? And then from there, your anchored VWAP from here, breakout here, even the low from back here. I mean, pullbacks here. You should be thinking about buy side trade first on higher lows over 456.30. Do the internals, does the supporting evidence support this idea? Let's take a look. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. I'm just going to let this sit on your screen for just a moment. What do you think I'm about to say about the internals? Because you're probably right. Clearly, buyers in control on Friday. Strong breakout, substantial volume flows up and over positive 300 million. In terms of net flows on the week, positive 812 million. The threshold is 500 million. Really, really strong reads net on the week, all really due to Friday, but clearly building, right? In terms of advanced decline line, building into trend higher zone, that's incredibly strong, especially coming from an open under the zero line on Friday. And look at the cumulative tick. It really speaks for itself. We're always looking at positive or negative 5,000 reads as being substantial. We hit 5,448 into the close of Friday. So very bullish. That would validate the breakout from Friday's session. The thing that's a little bit more nuanced, though, is take a look at Wednesday. What happened on Wednesday? That's really the strongest day in the downward direction. Even take Thursday. Wednesday is bullish advanced decline line. Thursday is bullish advanced decline line. Bullish volume, bullish cumulative tick, bullish cumulative tick. So even when there was some sell side pressure flipping into an hourly downtrend, the internals were actually on the bull side of the market. I would say that the buyers are clearly flexing the momentum muscle and they are in control. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, let's keep it simple first. What's going on with the value area and point of control? Well, Thursday to Friday. Here's Thursday, here is Friday. Your point of control also drifts in the upward direction. I would say that's a bullish move there, but what you might also notice is, okay, here is the value area from Wednesday. Here's the point of control from Wednesday. It's technically underneath, and I would just make the argument, if you turn on the 30-minute session, or I should say the additional 15-minute session for our futures, your point of control and your value area certainly migrate in the upward direction. And this is fairly substantial because you'll also notice that this didn't move higher, this didn't move higher, so it's still apples to apples. This is a higher point of control. This is a higher point of control. You're just including the 15-minute extended session after the 4 p.m. cash close. But let's bring it one step further. A couple of things have taken place here. We had a spike on the Thursday session. We technically opened here at the base or even slightly underneath the spike. What should that mean? Well, from a spike rules perspective, anybody who initiated a long trade into the close of Thursday should have been underwater on the open, leading them to become overhead supply. And you can see that it's not just thin volume like what we had over here at the base of the spike. Up here, there is some volume commitment. So if they were going to become overhead supply, we should have looked for some sell side pressure towards the point of control as a typical first target on a spike rules play. Obviously, that was not the case, and we ripped through it in the upward direction. So this is a failure from our sellers, right? The next thing to point out is that we have a double distribution on the Friday session separated by a string of E-prints right here. And you'll notice that with the end period on, and even if you were to turn it off, let me just turn it off for a brief moment. We're splitting hairs here, right? If I go back to 1600, you'll notice that this point of control, where that point of control would have been, it would have been right here, is almost on par with the point of control from down here. We're probably off by just a handful of contracts. Let's zoom in. Let's do it together. Let's go through the exercise and figure out what the number is. So 23,618, and then up at the tippity top, what we're looking for is 23, any 23s, no 23. Oh, here we go, 23,575. So you're off by just a couple hundred contracts, really not a big deal. This could have easily become the point of control. And again, the main takeaway here is that point of control and a bulk of the value, a bulk of the volume that was transacted happened in the upper distribution. So this, as a matter of fact, now just says that, okay, any longs who initiated down here have decent location. We are getting price acceptance near those highs. The first precursor of a breakdown into the coming week's worth of trade would be a breakdown underneath the single prints, or into the single prints, I should say. So what would that mean? It would kick off a move underneath 45.92, then longs late to the party turn into overhead supply. The target would become what? The point of control from the lower distribution, closer to 45.72, 71. That would become a potential target. But what do we know about 45, 75, 72? That's really just the top of the consolidation range. So what does that mean? It's just a pullback. Let's barring the point of control being down here, if you break down through the single prints, this is your daily high or low. It's still your hourly high or low on a retest of that potential level. We'll change our tone if we get price acceptance back within the range, but as of right now, the market profile also stacks up as a bullish data point. Shifting gears to the QQQ monthly time frame chart, what do we see here from a candle structure and location point of view? Very similar to our S&P, so the November bar, solid green-bodied bar, a little bit more of an upper wick on the Qs, but really minor in relationship to the size of the overall body. It certainly did produce a higher low as well as a higher high on the bar-to-bar count. Certainly a bullish engulfer, taking back 1, 2, 3, not days, weeks, months of bearish price action. A difference here over on the QQQ is that we are actually nowhere near higher, and this higher low was nowhere near the neckline of this as a pseudo-esque sort of inverted head and shoulders. Really, really sloppy right shoulder. The pullback was hardly, it's more clear on the weekly, right? So this was certainly a much higher low, and we've actually broken through the top of the summer high to technically trigger what you could start to consider a weekly cup and handle. So as we know, the breakout should bring us at least to the all-time high, if not continuation, when taking a measured move from the top of the cup to the base of the cup. All of this, just like the S&P, is happening over an upward sloping 50-month moving average. And if we take out the Fibonacci's from the low of the sickness up to the all-time high, one thing to point out is we'll always give credit where credit is due. The bears did do a great job of at least testing the 61.8, but all of this consolidation is certainly happening above a 38.2, furthering the bullish case on the monthly time frame. Let's drop it on down to a weekly chart here. And on the weekly chart, things start to become not so clear, a little bit more convoluted with structure and location. So let's be explicit with it. What do we see? Structure and location. Certainly more of an indecisive doji out of the QQQ weekly bar. Now, let's not get it twisted. It is a green close. We closed over the opening print, but the upper wick would suggest some sell side pressure after breaking for the highest high in this overall trend sequence. Now, again, credit where credit is due. The buyers also stepped up towards the lows of the weekly bar. And if we think about location, we've got two equal lows and a very nuanced higher high, but we closed inside of the previous weekly range. So again, nothing about the chart yet is suggesting that we're about to flip into a weekly downtrend, daily downtrend, but if we were to take out the two equal lows, there are much higher odds of a pullback actually unfolding over on the tech side of the market. And something worth pointing out is that the XLK, the tech component of the S&P, is roughly weighted to about 28% of the index. So if your QQQ breaks down through those equal lows, it wouldn't be unreasonable to see some slowing of momentum over in the S&P market. So what do we have for potential pullback levels over on the QQQ? The main thing you want to be thinking about is going to be the CPI gap close at 378.25, which is loosely in alignment with this prior structural high over here. Is it unreasonable to see a weekly bar that breaks those two equal lows, pulls back here? Absolutely not. You're still looking at a beautiful higher low on the weekly trend count. Remember that we're coming from the lowest low. A higher low on the weekly would be welcome at this point in time to help gauge risk as we move into the future. All right, so if the CPI gap fill does not produce a reversal, what's the next major line in the sand? It's 370 out of your QQQ. If we can hold on to 370, that would be the next major structure to think about. It's really the bottom of the double inside bar range over here and where we got the lower high previously while we were still in an overall downtrend. The confluence is not as beautiful on our QQQ, but we will go ahead and throw on our anchored view apps here. You're getting a little bit around that 370, 371 level with the anchored view apps, but nowhere near what we're at currently. If you bring out a Fibonacci from the low of the move all the way on up to the high, you're kind of, the 38.2 is in no man's land. The 61.8 is a little bit deeper. The 50% might be a little bit more closely aligned with the 370 area of potential support, but the main illustration here is that we have plenty of reference points underneath us that have the opportunity to at least provide a higher low if we were to break down underneath the two equal lows in the first place. Once again, I want to put some emphasis on that word if there. Let's bring it full circle with the volume profile, and then we'll move on down to our daily time frame chart. What do we see here? As we know, strong recapture of the highest volume node. This is loosely aligned with that 378.25 gap fill reversal for CPI. A little bit of a volume shelf there. You can see the protrusion before coming in, and then the high volume point of control down below. Once again, the main illustration, plenty of reference points underneath. If we do move in the upward direction, a little bit of early rejection around 400 from a volume shelf, and then it's all-time high here on the weekly. Let's take a look at the daily. So first and foremost, expected move is a little bit more neutral than what we have over in the S&P with the projection of a higher high if contained at 396.64, but notice the lower low down here at 383.25. That, of course, is a breakdown underneath the lows of last week, triggering the break of the equal lows on the weekly chart that we were just talking about could usher in a more sizable pullback. So expected move is neutral. Don't get me wrong, the daily trend is still technically up because we have closed here. We broke to the higher high on Wednesday. We did pull back. We did flip into an hourly downtrend. And then, of course, the elephant in the room is that we did not validate this breakout with a higher high on the Friday rip from the JPOW commentary, from the PMI data that we got earlier in the morning, from the projection that the Fed will be cutting rates sooner rather than later. So definitely relative weakness from that point of view, and we're really just stuck in this balance range right here. And it makes our job fairly easy in my eyes. Obviously, the buyers would want to have this hold as the higher low from the overall sequence, because once again, we did flip into an hourly downtrend. This counts as your next daily higher low, right? We had lows, big gap, higher low. This could act as a daily higher low, and we're coming from the highest high. So this must hold if the buyers are going to remain in control. Obviously, from there, the buyers want an inside bar breakout, because technically Friday is completely contained within the Thursday range. Break the equal highs, break the top of the range. We're back off to the races potentially up and over 391.15. That could be a possible bullish breakout. We're looking for the high of Wednesday session to act as a potential target before the next structure up near the upper edge of the expected move. 397 is that potential target. Where do the bears gain control? Obviously, it's underneath the low of the Thursday session. You could look for a breakdown from the balance range, lower high underneath, and then it's all eyes on the CPI gap, right underneath the lower edge of the expected move, and this certainly becomes a target, or at least something to frame trades around for our bears. Under 383.25 closes at 378.25, and just like we talked about on the weekly time frame chart, you have the opportunity for a weekly higher low down here. So even if we flip into a daily downtrend, keep your mind open to the idea that, hey, a weekly double, or I shouldn't say a weekly double bottom, but a daily double bottom could lead to a weekly higher low is really the more appropriate way to word that type of analysis. Let's move along and throw on the daily anchored view app spread. What you'll notice is that we're over all of the key anchored view apps. Obviously, even the anchored view app from the CPI gap up, even though we did not break out on that Friday session. So as long as this holds, you are getting decent confluence around 387.25, being a line in the sand that must hold if the Qs are going to remain bullish here. Let's move on down to an hourly time frame chart and see what else we can learn about the price action. We will get granular. It's a lot of the same commentary as the S&P with the failed breakout here, giving the bears a gift. This was price acceptance. Notice that we had multiple inverted hammers on the hourly underneath the bottom of the range from in here. It's still that same level at 387.25. That failed, right? Here's your end of day ramp. Notice that we did not produce a spike. We did not recapture the opening print of the Thursday session. And the same thing happens on Friday. Technically, Friday opens underneath or inside? Inside, technically. A little bit of a drive lower, breaking down through the level again, only to be promptly recaptured at the 10 o'clock time frame. PMIs came out, right? And then we're back up through the midpoint of this range. You have a minor level here at 388.85. So what's the game plan going forward here on the hourly time frame chart? Well, with Thursday's failure, with Friday's recapture, also closing up near and producing an inside bar near the highs of Thursday's session, that's Friday, the breakout is probably the first thought, considering that we're still technically in a daily uptrend and we've tried to produce a daily higher low. So if we can take out the highs of this balance range, I would really want to see price acceptance. We're talking about 15-minute opening drive higher and higher low here. You're trading for continuation of the daily trend up and over 391.15. If we just remain stuck within the overall range, you guys know the name of the game. It's P for patience. You need to be patient for something that looks like this. You need to be patient for something that looks like this. I would not really take a lot of aggressive bets being stuck in this really compressed range. Now, if we are getting consolidation over the midpoint, that 388.85, maybe there's a bullish edge, and again, you would favor something that looks like this. But if we're really just sloshing around back and forth, I would not expect anything. You would really manage your expectations inside of this box. There's no reason to believe that there needs to be any particular move from the market in that range. Obviously, to the downside, if you could get a firmer lower high that then breaks to a lower low underneath these levels here, as a matter of fact, let's pick those off together. We're talking about 386. On a breakdown of 386, you might actually get a more substantial move in the downward direction, actually violating those lows of the Thursday session, right? And that's where we talked about kicking off a daily downtrend by not holding on to that zone. So what would the target be? Of course, the rotation down here, 383.25 CPI gap close, and then we're back off looking for weekly higher lows and daily double bottoms, hourly trend reversals around 378.25 to respect the higher time frame trends that we've really just been discussing. Let's move along and take a look at the market internals for the NASDAQ side of things, and I would have very similar commentary. Notice, though, that the NASDAQ breadth is not as strong as the ES on a relative basis. What you'll see here is about 592 million. The substantial threshold is 600 million out of the NASDAQ. We obviously did not hit that, shy by about 8 million there. Certainly strong reads out of the advanced decliner moving up into trend higher zone and a strong cumulative build here on the Friday session. The only issue is that you actually did get a little bit more neutrality, even bearish acceptance on the Thursday breakdown over here. You can see Thursday had outflows. Thursday did violate and break under the zero line from the advanced decline perspective, but it's nothing major. So we're still giving the buyers the benefit of the doubt. We're just understanding that if you're looking for shorts, it's probably the NASDAQ where you want to be looking, not necessarily the S&P, and this is a great illustration of that. Let's move along and take a look at the market profile for the NASDAQ. One thing that I do want to do over here is notice that we have these inside bars, right? So the key question becomes, where's the average position? Where's the most volume traded in this area? Let's actually do an exercise of merging these profiles, and we'll take a look, and what you'll find is that the place where it's held from, as I just focus for a second, is actually lower in the overall range. So the value area and point of control are lower, which might seemingly indicate, okay, there's bearish acceptance down here at the lows, but if you're breaking the highs, that means two things. Number one, these people, if they're long, are holding from a really great location, right? They're feeling good about their position. They're fairly confident up here. Whereas if the value area and point of control were skewed higher in this overall profile, it's easier to turn this value and point of control into overhead supply by breaking down through that low. It's not the case when you could come all the way back down here and you just have buyers at break even, right? It's much more difficult to turn that into overhead supply and continue to put downward pressure on the overall market. Now, again, this is not like, hey, NASDAQ to new all-time highs type of bullish indication. It's a very nuanced data point that we're sort of referring to here. Let's split this again and let's take a look at any single prints and double distributions from Friday. Absolutely none. Nothing to write home about over there. Decent excess low. I would call it mechanical because it's so precise to over here. Lack of material excess at the high. If we were to move in the upward direction, again, what's your target? Probably looking for the highs. Whoa, funky zoom out of trade of 8. Probably looking for the highs up here from the Wednesday breakout 16.2. You would have to recapture the big bad level here from the NASDAQ futures at 16.1. And last but not least for the broad market, the problem child, IWM Russell 2000 and the small caps on a monthly time frame chart. What do we see here from a candle structure and location point of view? Very similar to the S&P and the NASDAQ in terms of structure. Solid green-bodied bar, very minimal upper and lower wick, not enough to read into. Strong close near the highs. Structurally, buyers are in control. Location-wise, a much more nuanced higher low, but it is there, as well as a higher high. So technically 2 for 2, but I think that the chart, the location, everything about this really speaks for itself. It's the laggard. We've known it's the laggard for quite some time. So here's the balance range that we've been stuck in on the monthly for almost a couple of years now. If we could break up and over 200, that's really the more constructive look for small caps to participate in the upside of the broad-based market rally that we're looking for. If the S&P is going to remain sustainable, if the NASDAQ is going to continue with some tailwinds, you want IWM to participate up and over 200. We have some decent steps. We're trying to move back towards the top of the range, but we're only in the midpoint of the range, so one step at a time. We'll give credit where credit is due. It's a nice hold of the bottom of the balance range down here with the reversal from the November timeframe, but we're still tangled around a monthly 50 SMA, unlike having all of this happen above the 50 SMA, like in the S&P and the NASDAQ. So some subtle weaknesses, but as we know, trying to make some subtle signs of improvement as well. If we take out the Fibonacci from the sickness low to the high, we are still technically within no man's land down below. We really want to get up and over 187, recapture that 38.2. We couldn't really do it here. We couldn't really do it here. This was a very sharp reversal all the way in the downward direction to the bottom end of the range. Can we do it this time? That will be a big level to watch. Once again, 187.70. I would just call it 188 at this point in time on the monthly. That would start to look much more constructive to get to the top of the overall balance range and perhaps test a break up and over 200, but one step at a time. Let's move on down to the weekly time frame chart and see what's going on over here, because this is actually different from the S&P and the NASDAQ in the bullish sense. Obviously, you can see we had a little 3-bar play that was setting up, but again, structure and location, solid green-bodied bar, a little bit of a lower wick on this one, but it would just imply that the buyers stepped up towards the lows. We had a strong break. Really, all of this was due to the Friday move, right? Nonetheless, it's a big move on the weekly time frame chart. The reason being is that we have a recapture of our weekly 50 SMA. We have a recapture of the weekly neckline, if you will, of this as a head and shoulders, and this inverted head and shoulders down here. It might be sloppy, but it's technically there, continues to hold. And obviously it's pushing price in the upward direction. That is a bullish indication. If we take out some anchored view apps, let's go ahead and move this out to the weekly anchored view apps, and we'll actually bring up a 5-year chart. The reason being, so I just want to show you that the top before the sickness and the sickness low anchored view apps are what we're basically coming into here as the darker gray dotted areas. So we've recaptured this one. Obviously we're well over the October low, but we are coming into a band of anchored view app resistance, and that is worth pointing out. If we come in from a Fibonacci point of view lows up to the highs of just the range, not the entire monthly range we were looking at, but you'll notice that you're getting some confluence. And once again, what's this area? It's right around that 187, 188-ish zone that we were talking about from the monthly perspective, right? So this is not an easy area for the IWM as we move forward into the future. We do have strong momentum coming off of the bottom end of the range, so I would love to see a world in which we break all of these and then retest for a higher low above, but I'm keeping an open mind to the possibility of a pullback based on the relative weakness over here on the weekly time frame chart. Let's go ahead and bring out our Fibonacci's, or excuse me, not Fibonacci's, but rather the volume profile. And what you'll notice here is a big recapture of your point of control, right? So this break in the upward direction really firmly got us away from the point of control. And you'll notice that we're coming into this as a high volume node potential area of resistance. Once again, it speaks to we're just stuck in a range. The momentum is not really in the upward direction on the higher time frames like the weekly. We're just imbalanced, right? So would it be reasonable for a pullback in the midpoint of the range off of volume resistance, off of anchored view app resistance? I think it's reasonable. I certainly think it's reasonable. We know that we haven't recaptured the 38.2 fib yet. I would keep an open mind to the Russell pulling back on the higher time frames, but let's take a look at the daily and see the momentum. So, I mean, forget about expected move, forget about trend, forget about everything. If that's not a breakout, then I don't know what is. I mean, this is happening on extremely strong volume as well in the upward direction. It's looking really good here for IWM. And the reason I want to focus on this for just a second is because it does tie into the fundamental narrative of perhaps the market really focusing on the rate cut coming or intended to come in Q1 of 2024. One of the larger beneficiaries of a rate cut would be the smaller companies who have been suffocated by the tighter monetary policy that's been in force ever since the 2022 highs, basically, right? The small caps really took a beating. So if this is going to happen, if we are going to get rate cuts, you might think in the traditional sense, when the rate cut actually happens, it is bearish, but if it means that the nature of the rally is going to broaden, it might actually not be as bad as we think, something that we'll dive into deeper as we get to our fundamental take today. But nonetheless, Russell breakout here speaks to the broadening nature of the market rally, and it makes sense with the fundamental narrative as well. So let's keep that in the back of our minds. Obviously, this is your range. Obviously, this is your break. Obviously, we have a recapture of your daily 200 SMA and a strong close up and over both of the shooting stars, which had rejected it prior. This is all happening once again on extremely elevated volume in relationship to what we had earlier on in that week. So the name of the game on the daily chart is extremely simple, right? We have lows, higher lows, higher lows. We have highs, higher highs just broke to a brand new higher high. Higher lows want to remain over the lower bound of the expected move, the daily 200 SMA. 181 is your level there. If you take out your anchored view at band here on the IWM, what you'll notice is that we're breaking away from the band firmly in the upward direction, whereas the Qs are maybe flirting with the CPI gap up anchored view app, right? Let's move on over. Oh, obviously you can see your upper targets as well. You can walk them up, right? A clear breakout here. You're talking about 187.75, upper edge of the expected move, and 190.10 coming from your prior pivot back up in that late August and early September timeframe. Now down to the hourly timeframe chart, right? Let's talk about how this actually unfolds. Clearly momentum in the upward direction. Clearly, I mean, if this was a micro nuanced range, the acceptance was above it on the Wednesday and Thursday session anyhow. You'll notice, and again, this is a big failure from the sellers, we broke down underneath and firmly into the micro range in the lower wick, if you will, of the first hourly bar on the Friday session, and then from there, the PMIs come out, Jerome Powell does his dance on stage, and it's just completely off to the races here. It's a very clear chart. I mean, on the hourly, this is extremely healthy and really good looking, healthy bull flag consolidation, breaks in the upward direction, walk up those targets we just saw from the daily. Anything deeper than that, you could even flip into a very nuanced hourly downtrend, not the end of the world. Daily higher lows can still be found up against 181. Just like everything else, where does the larger breakdown actually unfold? It's probably underneath this level down at 177.75. Let's bring out the anchored view apps from an intraday perspective. You'll notice you're getting some confluence here at the 183. Everything else beyond that, these will slowly creep up and start to provide confluence at that 181. Just once again reinforcing the idea that the daily 200, daily breakout level, very, very important. If the IWM was to pull back and find support here, that would look constructive for continuation in the upward direction and speak to, as we know, the broadening nature of the market rally. I didn't do this earlier, so this might not line up with anything, but let's just bring out the fibs from the low of Friday up to the highs, and literally you can't make this stuff up. The 38.2 is really not all that far removed from the structural 183 level, which was coming from off to our left. So IWM bullish in a nutshell. Let's jump on down to the internals for the Russell side of the market. Strong inflows on the Friday session, very strong flows on the week, with only Monday acting as a bearish force, obviously coming from negative up into trend higher zone, if not higher than trend higher zone on Friday. That does strike me as a bullish indication. Strong cumulative build on the Friday session as well, really negating a lot of the more bearish activity that was happening earlier on in the week, specific to the cumulative tick, right? You can see here Monday, Tuesday, Wednesday, like every single day prior technically closed negative out of the cumulative tick. Again, if the bears were going to have their shot at taking the Russell down, why didn't it happen on some of these early morning breaks on the Monday and Tuesday session? It just didn't happen. And then from there, we got higher lows, even on bearish internals specific to the cumulative builds happening in the downward direction. So sellers have failed, buyers are in control. Again, this is all tying in nicely to the fundamental narrative sustaining a market rally, specifically in the S&P. Remember that the IWM will help support the S&P. It's not going to do as much for the QQQ, right? So this is more of an indication for the S&P 500 market rotation, if you will. But if we jump on over to the market profile, I mean, let's dial it back. We've had some pretty bullish comments here for small cap so far. It would be irresponsible to not at least mention that, yeah, we do have some thin structure as a result of this bullish breakout. So if there was going to be a stronger pullback, I mean, we have some very clear targets out of the Russell futures, right? We know that 1800 down below, way down over here, is kind of what kicks off a stronger reversal. I would argue you could start dealing with a daily lower low if that were the case, if we were to take out 1800. But we have multiple strings of single prints, right? So 1850 becomes an idea. You have 1841 as the top of your next string, and then they close at 1835, and then the A period base down below is at 1815. Obviously, your value area and point of control did migrate higher, and we did not even include the 415 extended session. Once again, there is price acceptance near these highs. It would speak to bullish activity, but if we start to rotate through the singles, this turns into overhead supply. It's actually the opposite of the NASDAQ, right? This more easily turns into overhead supply, and then you look for these targets to close the singles underneath. You're still looking for, as we know, if I just scrunch this chart up, let's not get any funky zooms out of Tradovate. Here we are. There's the previous high, right? Any pullbacks that close the second string of single prints would still be bullish closer towards that 1835 zone we just discussed. Jumping back on over to the platform, let's take a look at the daily change of the S&P sectors on Friday in particular. That's, of course, when we got that big rally in the upward direction, so it makes sense to see who was leading the rally on Friday's session. Real estate, one of the larger beneficiaries of rate decreases, led the pack up 2.12%, followed by consumer discretionary, industrials, and then we see utilities, materials, financials, energy, healthcare, and then there's the tech sector way down below at 0.49%. Don't get me wrong, everything was green on Friday, but what I want to point out here is that the risk-off sectors were technically above the risk-on XLK, but not to a magnitude where I would say, okay, we have a leadership issue. We've also been checking in on the structural charts. It's not the case. Seeing the XLY up here at the top, seeing the XLI up here at the top, seeing financials up here at the top really does strike me as rotation for the broad market, sustaining the market rally, as opposed to a concern about flight to safety and risk-off assets. If we filter by weekly performance, what you'll notice, once again, everything is green. Leading the pack is real estate, materials, there's financials, third heaviest weighted sector by market cap, industrials, consumer discretionary, then it's utilities, then staples, tech is down below. Tech has taken a little bit of a breather, but is that reasonable considering everything that's happened over the last couple of weeks? I would certainly say yes. Let's take a look at the structural charts and just see for ourselves. I mean, real estate right right back to the top of the previous range. Any pullbacks here, certainly looking good over 37, even on a weekly basis, higher lows over 35.80, fine, good to go. Remember, upward pressure is upward pressure. Extremely lightweight sector. Unfortunately, it's not going to help out all that much. XLB, I was just looking at the sector reweighting the other day. If we come on over here, I can just show you. It's kind of comical. Let's have a laugh together, shall we? Look at the XLB. Materials way down at the bottom, actually underneath 2% weighting for the S&P at this point in time. And up at the top, again, Infotech Technology, XLK, speaks for itself. 28, almost 29% of the S&P. XLK, XLV, XLF make up collectively 3 sectors, 50% of your S&P 500. So let's move back on over to the structural chart, just so you understand, like, truly how much this does not matter for the S&P, right? It's going to help, don't get me wrong, upward pressure is upward pressure, but it's not saving the day. It's not going to prevent a market breakdown, even if this is going to the moon, so to speak, over in materials. Regardless, you can find higher lows. The trend looks good. Obviously, we've broken out over an inverted head and shoulders neckline. Can't really say anything bearish about this. XLF, different story. Third heaviest weighted sector by market cap, breaking to a big higher high. Great outperformance into the end of the week. The only question mark that comes up here is, if we're forecasting rate cuts, why would financials rally? That's one possible question. The only other takeaway that comes to mind is everybody panicked from SVB back here, right? And we're just renormalizing. We're saying, okay, credit spreads have come down dramatically. Doesn't look like we're going to have a credit event. Maybe we can go and rotate back into banks, back into some of the financial sector. That could be what's happening here. But again, the idea that banks are rallying on the premise of a rate cut, that one doesn't make too much sense. So nonetheless, from a technical point of view, higher low, I mean, hell, weekly higher low speaks for itself, right? Very, very bullish, constructive XLF chart. You can't find anybody who would call this bearish. And if you do, let me know. We need to have a chat. XLI, let's speed it up through some of the lighter weight sectors, 8%, right? Making that equal high back here. Higher lows on the table. Anything over the breakout point, 106.50. Nothing really bearish about this. Maybe it could pull back. Maybe this week is a pullback, right? That's fine. We're still looking for higher lows across the sectors. XLY, a little bit of a struggle here on the Friday session. We know that it really hasn't been participating on the breaks ever since the CPI gap and go. It's definitely bullish with the failed breakdown here into the CPI gap, but it has not really accelerated up and over the top of the range. That could be subject to change as we move into the early stages of this week, looking for an equal high break and then continuation to your next pivot. Once again, this does strike me as a bullish chart no matter how you slice the cake here. Even looking for a pullback, higher lows just stay over 169. XLU utilities, is it threatening leadership? Again, no. We've just renormalized to the top of the breakdown from what happened in the panic of October. Does not really strike me as a threat, even though it may have looked like it was towards the top over your XLK, right? XLP, same comments, breakdown, renormalizing over here, not an issue. XLK, again, just let's do it together. Here's the XLK, here's the XLU, here's the XLK, here's the XLU. Any issues with this market? No. I mean, this is certainly bullish consolidation. It's certainly bullish and speaks to risk on assets performing right now in the market. These are all-time highs. This is bull flag consolidation. We have lower wicks at the retest of these lows, 183.25. Again, hard pressed to find anything bearish about this. Even if we do break down, you could find a higher low at the top of the gap fill reversal, or the top of the weekly range from back down here at 175. So could we see some bearish pressure for the market in this upcoming week? Yes, but just for a pullback. Next up, XLV, second heaviest weighted sector by market cap, playing nicely in our overall range. We've talked about a couple of really ugly inverted head and shoulders. There's one. The other one would look something like this, and potentially a break up and over 132.65 continues to broaden the aspect of the market rally that would sustain higher prices in your S&P. Not so much, obviously, over in the NASDAQ side of things. XLE, let's have a conversation, because energy and crude are sort of not aligning with global, I would say, resiliency in economies, especially if you take a look at crude. Crude was impacted, or should have been impacted, by OPEC oil cuts, and even with cuts, we're moving in the downward direction. So this really speaks to demand destruction. Nobody's interested, like production, not good on the CL front. It's a minor data point that we're carrying forward from a global narrative perspective. It's not like we're going to go out and short the S&P because crude is so weak down here, but it's one data point to at least consider. So have that in your back pocket. Lastly, XLC, then we'll go on over to the SMH as well for semis. It's going to look extremely similar to the XLK, but communications, again, talk about a pullback. Maybe this is what it has to look like over in the XLK. As we pull back, we're starting to find buyers on the retest of the top of the gap at 69.30. Gap fill reversals bullish, even finding a higher low on the weekly over 68.10. Daily 50 SMA catches up. I mean, beautiful weekly higher low. Lows, big time higher low. You have to remain constructive on more risk on style sector. Last but not least is the SMH. What do we see over here? Again, very similar to your XLK. There's your flag, all-time high. If we get a break, blue sky territories. If we do get a pullback, not the end of the world. Weekly higher lows over 152.25. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner if you want the free way on how to set it up. If you want to just skip the hassle and actually get all of the chart books that I use in these weekend updates, just click the link down below in the description that says trading-scripts, and you can find the charting package for Thinkorswim over on the website. One caveat is that if you have not swapped over to Schwab yet, the links will not work, but when you do convert to a Schwab account, those links will subsequently work, okay? So do not, do not email and say, hey, it's not working. That's probably why it's not working, okay? But anyways, let's get back to analysis here. What do we see out of the XLK ratio? Certainly looking good. It's still high and tight, but it is rolling in the downward direction as the XLK goes sideways and the market continues. So to be expected over there. It's done its work. It's already broken out. Notice that the XLF, it's really starting to perform here on a relative basis up and over the flat top. This is a risk on indication. This is a risk on indication. This is not outperforming, so we're not seeing a flight to safety here, not seeing a flight to safety here, not seeing a flight to safety here. Industrials playing nicely. That does speak to overall economic strength, right? XLY would be great to produce a new higher high. We're holding on. At least we have a sequence of higher lows. XLC, not really doing so hot over here, but we do know it's one of the major risk on sectors that's actually pulling back instead of consolidating. Energy really suppressed down at these lows. Real estate, the rate cut benefactor as well, moving in the upward direction. So overall, risk appetite, risk on sectors seem like they're doing what they should be doing currently. Let's move along and take a look at the XLK over the SHY, government backed, right? This obviously is a bullish indication hanging out at those equal highs. Same thing with the XLK over the XLU. Mild drift, but as we know, it's a rinse and repeat, right? Here's a little micro head and shoulders. Here's a little double top, pull back to the 50 SMA. As long as we can produce a higher low, this is a risk on indication. And then let's go apples to apples, XLY over the XLP. Consumer staples versus consumer discretionary. It is holding up over the top of the range. We have not spent this much time over the top of the range, so I don't want to jinx it, but it is starting to look constructive as a risk on indication over the top of 238. Let's move along and take a look at the dollar, which actually saw a little bit of a rebound, but it was not reflected in the market at all. Here's your rebound off of the lows from the Wednesday session. Obviously, we move a little bit higher. PCE is a nothing burger. Unemployment claims are a nothing burger. We moved mildly towards the midpoint of the range, but we didn't even get a pullback out of the broad market over here. So as long as this remains weak towards the midpoint of the range, I really wouldn't be all that concerned for pressure on equities unless, right, something like this takes place. So dollar, still a weekly opportunity for a lower high underneath that 105.65. And all of this really is fairly interesting considering that gold, absolutely no pullback off of the equal highs here, breaking out on that Friday session higher. And even the precursor, right, silver, same idea, right? Here is the, boom, there it is. Your equal highs that we were looking for a bit of a rejection around broke out on the Friday session. I know that those contract rolls are green as well. It's not helping, but we did break in the upward direction. So no pullbacks there, meaning that, okay, let's look for the dollar to continue to move in the downward direction, continue to alleviate some pressure on equities down below. So far, this is still a bullish relationship. Let's move along and take a look at some interest rates through the lens of the TNX, breaking down more aggressively on the Friday session, even with Jerome Powell's tough guy face, right? Breaking down underneath that 43.33. It's going to alleviate pressure on specifically smaller caps and companies that, as we said, were suffocated from higher rates. So this does strike me as a help for the broad market. You might look at it and be concerned, and there is a valid reason. There's really two approaches to rate cuts, but if we continue down, like let's actually go over to the ZN, like, if someone actually is trading rates, I mean, what a beautiful setup for the inverted head and shoulders breaking the neckline here. Any retest, any higher lows over the 108.3 handle looks really good out of the 10-year note, right? So I'm not really seeing a reason where the TNX is going to rapidly reaccelerate in the upward direction. You're basically asking for notes, ZN here, to fail that neckline retest, fail the trend line, and just go back down to the lows over here. It wouldn't make sense from a structural and pattern perspective on the note, right? Let's move along and take a look at the inverted ZT, which is the 2-year, of course, and this is how we track the implications of the 2-year yield and thus what the Fed is likely to do. Aggressive breakdown. So a couple of things, like you could be saying red flag, the Fed has broken something, or you could be saying no, we're just going to ease and we're going to see again the broadening nature of the market rally as smaller companies who are dependent on cheaper money basically come back into the fold as being okay, bullish companies, right? So two different ways to look at this. this. And the other thing, we often do not talk about this, and this is also included in the chart package if you're interested over on the site, but here's the 10 and 2 year curve, right? We're re-steepening, which is classically seen as a bearish indication. If you just hover the cursor, let's look at the re-steepening here, right? Re-steepening here technically aligns with what we have here. Re-steepening here, great financial crisis over here, right? So this is typically seen as a bearish indication, but we have not crossed the zero line yet. We have not moved back into positive territory. It's something to keep an eye on. It doesn't mean that the market must crash when that takes place, but this would also support more of the data-based, no pun intended, data-based bearish supporting evidence that, hey, when we start to cut rates, it's very possible that that's when the crash could come. Let's take a look at the tracker tool and dive into the fundamentals. So take a look over here where you can clearly see that we have much more aggressive rate cuts coming in with less pauses and an additional 25 basis points of cuts expected, as now being reflected here at 400 to 425 basis points instead of 425 to 450 just a couple of weeks ago in mid-November. I'll flash up the old screenshot on the screen now. So remember that we really need to keep track of this because it represents two things, right? Number one is that perhaps the Fed went too far and we need to price in an emergency, like let's get rates down as fast as possible. Otherwise, we potentially fall into a dark and dirty recession, as we've been calling it. So that's situation number one. That's more indicative of a bearish accident. If you're more bullish on the market, if you're more of an optimist, then situation number two is what we were talking about with IWM, which is, hey, we're actually giving an easier operating environment for the broader cohort of U.S. companies with cheaper money, and that's a bullish improvement. So depending on which way you want to look at this market, those are really your two frameworks to follow from a fundamental perspective. Now, from a data point of view, and as we were just joking about with databases, if we just jump back on over to Thinkorswim, notice that usually when the Fed actually starts to cut rates, bad things happen. When the Fed starts to cut rates, bad things happen. Starts to cut rates, bad things happen, right? Pull back, so on and so forth. You get the idea. The biggest illustrations were the dot-com bust and the great financial crisis over here. We all know that this is the sickness, but if we start to cut, will we get more of an aggressive downturn? That would certainly align with the accident thesis that we just talked about with situation number one. So that would possibly be more of a bearish indication. If we just jump back on over here, though, one thing I do want to talk about is if we take a look, the data really hasn't been coming in all that bad on the unemployment claims. We came in at the expectations. The chefs did a great job of cooking up a beautiful 5-course expected meal here. 218, 219 was the expectation. Inflation, basically a nothing burger, 0.2 on the month-over-month core PCE. This right here is really what the Fed cares about. It's the labor market that will have to break if we're going to enter a deep, dark, dirty recession, and so far it's not doing it. Even if we get PMIs, which are sitting here, definitely missed on PMIs, and you'll notice 10 a.m. is when those came out. That's exactly when the market started rallying, right? It's not when Powell started speaking at 11 or 2 in the afternoon. It's the 10 a.m. time frame when we got PMIs, and this is your indication of economic contraction. And if we still have a strong labor market, then guess what? You're really not going to see the deep, dark, dirty recession because people still have jobs to spend money, right? So as long as the labor market remains intact here and you're not seeing this big spike in unemployment, I would make the argument that, hey, we could probably think about situation number two, at least, allow situation number two to exist in your framework, in your mindset, and not just write it off as completely like, nope, this is BS. Whenever cuts happen, it's got to be bearish, right? This is how you achieve the soft landing. That's the path. Whether or not we can actually pull it off is a completely different story. If we take a look over at earnings, what do we see over here? This also ties into what we are discussing right now. This is what we have seen out of the market. That's the S&P in the blue dotted line. These are earnings expectations for Q4 of 2023. Notice how those two things are diverging. What does that mean ultimately? We are only seeing the market move in the upward direction based on a PE expansion, not the forecast that earnings will improve. So if that's the case, then yes, we basically need to see rates cut, and then this will justify prices like what we have up here. But keep in mind, when the rate actually gets cut, when Jerome Powell says, hey, the Fed has decided that we're going to lower rates by 25, whatever he says, right? that is not when the market is rallying. This is already pricing in that he will say that. So do not expect to be bullish when the day actually comes that the Fed lowers rates. So don't rejoice when that meeting ultimately unfolds. But this does explain how earnings can fall and PE expansion is really driving your market. Let's jump back on over to Thinkorswim and round out our risk appetite charts. TLT ratio to the S&P, it's right at the resistance trendline. If it breaks sideways through time, as we know, this is not a risk off indication. We are not concerned about risk appetite if that's the way, if that's the nature in which that trendline breaks. Bonds relative to themselves drifting in the downward direction would speak to higher confidence in longer duration risk assets. That is a good thing for equities down below. If we take a look at credit spreads, they are continuing to produce, all over the place here. New credit spreads, there we are. Lower lows here in our medium-term IEF LQD, shorter-term SHY HYG, still not quite breaking those lows, but certainly sitting right on them once again. This does speak to bullish odds for the S&P equities down below. Let's move along. Take a look at the HYG in isolation. Remember that we called out this divergence on the Wednesday update? Yeah, it seems as though the market actually played catch up to the HYG. So that has sort of been resolved, if you will, actually breaking to a higher high, but it's still a little bit interesting. I would continue to keep an eye on when and if the HYG does ultimately diverge from the S&P. Still keeping an open mind there. S&P, let's move over to Bitcoin actually and take a look at this one. Clearly breaking from a bull flag consolidation. This does speak as a bullish data point for the broad market. Not one-to-one, but as we know, it's worth keeping tabs on crypto. Let's move along and take a look at market breadth. This is where we see some really substantial improvements with new highs versus lows breaking big time up and over the zero line, actually pushing towards some of those more respectable reads 200, 500 zone, right? Remember, we don't need anything blockbuster to begin. It can start off slow, but this is a big improvement out of breadth, right? Similar comments over here in the SPX A200R, big break up and over the 50% mark. This is a big improvement. Again, let's take a look at the SPX A50R, same song and dance, big improvement. We are getting into contrarian zone. I wouldn't be, it would be understandable if you looked at this chart and said, hey, we're getting into that time and place where it's totally reasonable for a pullback. We're overbought on the SPX A50R, not unreasonable. So keeping that as a maybe back pocket contrarian data point. Let's move along though and take a look at equal weight S&P. This again speaks to the broadening nature of the expectation that rate cuts will help improve operating conditions for a majority of companies. It's not just the Magnificent Seven who ran the rally on the Friday session. Look at your RSP breaking to an equal high back here, way up and out of this consolidation, whereas the S&P weighted has not broken out of that range nearly as aggressively. This is a bullish indication. It speaks to the rally becoming more sustainable if the RSP can keep that sort of pace in the upward direction. QQQE, same concept here, breaking to a higher high, whereas obviously, as we discussed, pretty staggering divergence with the QQQ weighted NDX in this case, just hovering sideways in that overall range. So some bullish improvements big time overall in breadth. And last but not least, breadth-wise at least, look at the Dow transports. Again, breadth-wise, major moves on that Friday session, getting a break up and over the inverted head and shoulders neckline, trying to play nicely and catch up to industrials over here. We're still not one-to-one. Obviously, we have this big distance from here to here versus here to here. We are divergent from that point of view, but this does speak to, once again, improvements. It's all about subtle improvements in technical analysis and looking at the environment in which we are ultimately trading. Let's move along and take a look at the VIX. This is where we've got some additional analysis to perform here. Sitting on the lows out of the VIX, nothing surprising over there. Let's move along to the VVIX. What do you notice? A little bit elevated, but still in a comfortable zone. Remember, we're not floored down below at complacency zone. We're sort of in a respectable area. Then last but not least, let's take a look at the volatility futures, because this contango is almost getting out of hand. To some degree, you actually don't want to contango this steep. You kind of want to be more comfortable, like maybe -1, right? Because what does this mean? It means that nobody trusts the future, right? This is speaking to the spread. As a matter of fact, we can just go over here and I'll show you. This is speaking to the spread between current volatility. You can see, oops, we want to get rid of that. There we are. 18-day volatility at a 1370, whereas if we just go down to the next active contract at, you can see January here at 46 days, 1548. It means nobody trusts the future, right? Sure, we're all fine and dandy with what's currently happening under current market circumstances. There's more risk in the future, but it's like instead of being here, like, there's always going to be more risk in the future. It's kind of uncertain, right? Nobody trusts the future. We're up at this much of a distance, right? So this deepness, the depth, I should say, of this contango, it's not like we go out and short the market because of this, but it does speak to a lot of people lacking trust in the sustainability of this near vertical rally in the upward direction. And also, I mean, again, not for nothing, go out to the VIX and you'll just find that, you're getting some really cheap, let's go way further out. Let's go, 45 days out. You're getting some cheap insurance over on the VIX, right? This is really very, very cheap stuff over here in the VIX. You can come in and you can bring out your implied volatility. There we are. And, look at the implied volatility and then look at the pricing of the options. It's fairly cheap, right? So I would make the argument that, again, a lot of people can go out, they can bet against the market, but it's just cheap insurance. It's not necessarily an indication that the market needs to go to zero. If you've made it to this point in the video, I appreciate you coming out to the show. I know it's a long one, and I know it's possibly a late one. We had, obviously, monthly charts to go over, the fundamental analysis to go over. We had some delays with the Thinkorswim outages. If you're watching on a Saturday night, let me know midnight special down below in the comment section with the keyword. We haven't brought that one up in a while. Or coffee and charts on a Sunday morning is always fantastic as well. I'd love to hear from all of you in the comment section. Let's take a look at Apple. Clearly a range. If we do break in the upward direction, you have something like a daily, weekly bull flag here over 192, target 195, and then we're gunning for 196.75, all-time high 198.23 after that. To the downside on the daily chart at minimum, I would really wait for a range break to travel through this thin structure, then look for a daily higher low around 185 to 183.75. On the hourly chart, if we just split that range in half, you can see that we've got this midpoint inflection point, consolidation up here, favor bullish breaks, consolidation underneath. I'd keep an open mind, but because of the strength of the daily chart, this is a nice to have on the hourly to the upside, but the hourly and daily trend is up. To the downside, I would require something that looks like this if you're going to try to trade the breakdown to target this area for your daily higher low. Moving along to Softy, let's take a look on the daily first. You'll notice a little bit of a pullback unfolding here. And again, you'll see that the S&P actually broke to that higher high on Friday. A lot of tech did not perform. You're seeing lower moves here over on Microsoft, second heaviest weighted stock in the S&P as a whole, right? So if we break down underneath this 371, you are looking for continuation and a major higher low on the daily around the prior all-time high 364.25. But we do have a hammer here and we do have a longer lower wick. The buyers were able to close in the midpoint of that Friday breakdown range. Let's move on down to the hourly and see if we can get a little bit more nuanced, right? If this is going to act as our infamous Man Ray pattern, right? A recapture of that neckline. If the buyers early on in the week can get this kind of recapture here over 376.25, this could act as your daily higher low at 371. And because we have a daily hammer, right, the trade is usually a little bit more straightforward than some others, long over the hammer high. The hammer high is more closely aligned with 379, so consolidation here sets up the trade, and then a break like this, you're back off to the races long and basically gunning for all-time highs, right? Let's move back to a daily and take a look at GOOGL. A little bit of a deeper pullback. Again, speaking to the underperformance from tech into the end of the week, the Magnificent Seven were not responsible for the continuation in the upward direction. So if we can hold this, just like Microsoft, daily higher low is possible, 131. You do have to recapture, rebattle through daily 50 SMA and lows here at 133.33. So bears get the benefit of the Dow underneath, then we would look for a downtrend because this was your last set of daily higher lows, right? You have lows, higher lows, higher lows. This is broken to a lower low. This technically is a lower high. So it is possible that this could be a favored outcome out of Google. So the main inflection point here, what this all revolves around, is 133.33. You're either going to reject it and you will trade in the downward direction, look for bearish patterns on the hourly here, or if we recapture, it's the higher low above that starts to kick off the sequence back in the upward direction. Big retest would be where the breakdown originated from at 136. Here it is on the hourly chart, just for a little bit more clarity, right? This is a rejection. This trades for the origin, which is up here 136. Next up, Amazon. What's going on with no longer last but not least, but certainly still the mini beast? Equal high break possible over 147. The target could not be clearer. It is your highs from earlier on in the week. And then you are looking at 150, the nice round psychological number. Also structure from off to our left. Amazon, a little bit lackluster, but certainly more of an equal high possible break, more similar to the QQQ versus the larger breakdowns like what we saw in Google and even over in Microsoft, right? Let's move along and take a look at NVIDIA. What do we see on, we want to stay on the daily. There we are. Big pullback, right? And what have we been asking for? We've been asking asking for some sort of pullback this whole way. So is it not time to put our thinking cap on and say, can we find a daily reversal around this area? So if that is the case, then we will look for something constructive that likely has a recapture here and maybe a neckline that looks like this, right? Can you see the inverted head and shoulders? There it is. There's your neckline, 484. Obviously, a lot of things need to happen for that to be a play. If we just continue in the downward direction, there's still thin structure underneath us. A lot of these targets could be hit if we never produce the daily reversal in the first place. First target downside is 450. Anything beyond that, this is definitely a stronger weekly level that needs to be respected based on the double bottom offering the reversal in the first place at 437.25. Those are your ups and downs in NVIDIA. Let's move along to Metaverse. How's Zuckerberg's ACL doing? There is the hammer. Is it possible for a daily higher low? Not really. You've already violated this area back here. This was an hourly downtrend producing the big bar to bar lower low, right? So still giving the bears the benefit of the doubt if this is sort of your topping pattern there. As long as we're underneath that 329, bears do have control. I would be thinking about full retests of this level where the breakout ultimately came from and your daily 50 SMA 317. We know that 317 also keeps us out of this sort of forbidden range down below. There's a little bit more wiggle room, but please, let's not have to fall back down into this where it was just absolutely madness for Mr. Zuckerberg. Buyers have more control if we can get a higher low over 329 and then break through the equal highs at 330, 375. Next up, Tesla. What is going on with Mr. Musk? Balance range in play, look above and fail has completed. Gap down has closed. There's a lot of stuff going on here on the Tesla daily time frame chart. And to keep it simple, you could just look for your over and you could look for your under. If we are under, to gap close to 224, and also big opportunity for weekly higher lows, something that does this. So I'd keep a very open mind for buyers trying to step up at your daily 200 SMA and for a weekly higher low. If we bring it on down to an hourly chart, this is where it gets, again, increasingly a little bit more, there's more to pay attention to, but it is quite clear, right? If we do consolidate in the midpoint of the daily range, then what would that be? Gap fill, right? Now we're accepting back within this range, short squeeze over what? Well, where this bear flag consolidation was at 242.25. Over that level, I would start to think about the top of the range. That's a scalp intraday, and then much more constructive, higher lows outside of 246.25, right? So it's one step at a time if you're actually looking into the range. If you're being more patient on a daily, just, here or here. Keep it simple. Last but certainly not least is Netflix for the core list of companies. We finally jinxed the micro compressed range up at the top. Daily pullback is in store. Very strong trend. Lots of places to be thinking about daily higher lows. We do have a strong momentum bar to the downside on Friday, so I'm not thrilled about 467, but if we do see like a hammer be produced over here and then some sort of high back like this, it's possible for a daily higher low there. Remember that we're coming from this as a balance range that's certainly more than doubled at this point in time. We are coming into prior structure. The trend is strong. It's worth pointing out all of those things as we're considering Netflix daily time frame chart. On the hourly, how do we want to see this unfold? Right? I can envision a number of things already. Like maybe that's what produces your daily hammer if this head of the inverted head and shoulders is a little bit deeper. I know everybody, hates on the most favorite pattern of all, but that's one possibility with a higher low over here. Break that neckline, you're back off to retest the origin of the breakdown at 476.50. To the downside, if we do continue, I would love to see this turn into bear flag consolidation. No indications of that inverted head and shoulders. Equal lows over here. Another flush through thin structure. Lots of range to trade for. You're talking about 453. All right, and for the true heroes, I actually have 5.5 trade ideas to share with you, so you get a little bit of an extra benefit. First up is PG, Procter & Gamble. You're looking at a 3-bar play in the upward direction, bullish, of course. Mild pullback on the Friday session as the market was breaking out. They experienced the breakout on Thursday, of course, but notice that the pullback holds the prior 2 bars over here. We have a flat top. If this consolidation can hold, long up and over 153.50 to target your flat top highs over here at 155.25. This is in play as long as we can hold up over 152.50. Your 0.5 trade idea is a mirror image, but a little bit cheaper over here on CL Colgate Palm Oil. And you can clearly see there's your 3-bar play holding the lows of the prior structure over here. And if we break the 2 equal highs, we have much more of a hammer actually over on CL, just comparing and contrasting. Over 78.90 target, 78.90, yeah, I thought I said 79. 80 becomes the target. There we are, 78.90 to 80 in play as long as we're over 78.45. If we're underneath, you could still look for a higher low pullback on the daily, but to play momentum, that's how you want to see the trade unfold. So those are your first 2. Next up is going to be CRWD, CrowdStrike. Certainly a multi-bar play in the upward direction, but this is more like a double inside. So Al Brooks, classic double inside something that looks like that, break in the upward direction. There's lots of range overhead till the next major target. It's technically a gap from the sickness era as the fall from grace was happening. 253 closes at 257.30. That is your upside from a measured move perspective. I'd probably thinking about 250 a little bit before you actually run into that gap structure in play, as long as we can hold 230.25. Next up, we've got Roku, another sort of fallen hero of the tech space, if you will. And this is actually a bearish trade, right? You have a bearish 3-bar play with the inverted hammer on the Friday session, relative weakness into the end of the week, coming into a little bit of a top looking like over here. We're not overstaying our welcome. I mean, this is a strong break in the upward direction, but if we can flush these equal lows at 102.75, 97.50 becomes the target, and then we look for a reversal off of that. There's your daily higher low on the retest of these prior highs, but bearish in the meantime to get there in the first place. Next two are going to be on CAT, a little bit less traded, at least on the options chain, that is. So feel free to use shares on this one. But a couple of ideas here: either straight up continuation for day 2 follow through, you have thin structure to retrace, or subsequent higher lows and consolidation, want to turn this into a flag or a 3-bar play in the upward direction over by holding the previous breakout point here at 253.25. Underneath that, I would start to become more concerned. I wouldn't be bearish yet, but yes, we are in a downtrend here. Maybe this is a double top, but only if you were to violate the neckline of that pattern. I would not be trading this bearish if the broad market's trying to make a move in the upward direction. And lastly, speaking of strength over in financials, Morgan Stanley, inverted head and shoulders starting to break. Same idea. First target overhead is at 83.15. Consolidation over 80.50 is constructive. Even a higher low that's anywhere over your 50 SMA keeps this one in play. You could build out much more of an extensive right shoulder if you consolidate here and then break into the future. Just looking at this as a major first target, if I scrunch up the chart, you can see where this level is coming from. So those are your 5.5 trade ideas for today's session. If you enjoyed the video or learned anything new, let me know down below in the comment section, or by leaving the video a very simple thumbs up. It goes a long way, trust me. I hope to see you all bright and early on the Monday session up in the penthouse for the pre-market prep. And with that said, I wish you a green trading week.